Okay, let's dive right in. So, you're looking to buy your first rental property in Canada. That down payment, it's a huge piece of the puzzle and one of the most important factors when you're trying to qualify for a mortgage. But it's way more than just a number you have to save up. Your down payment literally affects everything, whether you get approved, what kind of interest rate you'll get, and even your overall affordability in the long run. So, in this explainer, we're going to break it all down. The goal is to get you comfortable with all your options so you can make a really smart, strategic move.
All right, so here's the game plan. We're going to cover documenting your down payment, the paperwork side of things. Then we'll look at where that money can actually come from. After that, we'll get into assessing your own financial firepower by calculating your net worth. From there, it's all about the minimum down payment rules. And finally, we'll tackle the big one, how your other debts can actually change how much you need to put down. Let's get started.
First up, documentation. And I know, paperwork. But this isn't just about the lenders being picky or trying to make your life difficult. It's actually a really big deal. In Canada, it all comes back to the Anti-Money Laundering Act. Seriously, because of that, every single lender is required by law to track where your down payment money is coming from. So yeah, it's not something you can skip. It's the absolute non-negotiable first step. So, what kind of paperwork are we actually talking about here? Well, you're going to need to show a full 90-day history for all the money you're using. And listen, that's not just the down payment itself. It includes your closing costs too. Every penny. Your bank statements have to be pristine. They need to clearly show your name, your account number, and you can't touch them. No editing whatsoever. This is all about having a super clean paper trail. And here's a big one. Any large deposit, think anything over about 2 grand, you'll have to explain exactly where it came from. You might even need to provide the 90-day history for that account too, so be prepared. Okay, so we've got the why behind all of the paperwork. Now for the fun part. Where can you actually get this money? Lenders are pretty specific about this, but the good news is you've got a few solid approved options. All right, let's run through the main sources. The most straightforward is, of course, your own money, your savings, your investments, anything that's not borrowed. Next up is a gift from an immediate family member. Super common. A slightly different version of that is gifted equity. That's where a family member basically gives you a piece of their home's value to use. Pretty cool, right? Then you've got the government's first-time homebuyer incentive. And for those of you who already own property, you can pull equity out of another property, or you can use the cash from selling an asset like a previous home. Okay, so when we talk about using your own resources, how do you actually figure out what you've got to work with? The absolute best way is to calculate your net worth. And look, this isn't some fancy exercise just for billionaires. For an investor, it's a vital tool. It tells you in black and white if you can truly afford the down payment, handle all the closing costs, and still have a cushion for those surprises that, let's be honest, always happen. And the formula couldn't be simpler. It's just your total assets, everything you own, minus your total liabilities, everything you owe. That's it. It gives you a perfect snapshot of your financial health. The key, of course, is knowing exactly what to count in each of those categories. So let's break that down right now. So, from the asset side, we're talking about everything you own that's worth something. You got the obvious stuff, right? Cash in the bank, your investments like RSSPs and TFSAs, but it goes way beyond that. Think about the value of any real estate you already own, your cars, and even valuable personal property like jewelry or collectibles. And hey, if you own a piece of a business, that goes in the asset column too. Now for the other side of the coin, your liabilities. This is pretty straightforward. It's everything you owe money on. We're talking mortgage balances, car loans, student loans, any credit card debt that's hanging around, lines of credit, you get the picture. Don't forget to include things like tax debt or any other financial obligations you have. So once you've tallied up both columns, you do the math and find your net worth. This number tells you exactly what you have to work with from your own resources. If you have a positive net worth, meaning you own more than you owe, that's fantastic. It could mean you have existing equity you can tap into for this new investment. Now, if it's a negative net worth, you owe more than you own, don't panic. It's just a sign. It's a signal that says, okay, maybe I need to hit pause, work on paying down some debt, or maybe it's time to seriously look at those other down payment sources we mentioned earlier. All right, so you know where the money can come from. You know how to figure out your own financial standing. Now let's get into the nitty-gritty, the numbers. There are basically 2 main roads you can go down for your down payment. And trust me, the rules for each are very different. Okay, let's break these 2 paths down. First, you've got the insured path.
This is for anyone putting down less than 20%. The minimum here is 5% on the first $500,000 and then 10% on anything above that. Now, here's the catch. You have to pay for mortgage default insurance, but the upside is you can often snag a lower interest rate. Then you have the conventional path. This is when you put down 20% or more. And for most rental properties, this is the way to go. You get to skip that default insurance, and this is a big deal. You can get a 30-year amortization. Why does that matter? It means lower monthly payments, which means better cash flow for your investment. And for any investor, cash flow is king. So you've picked your path, you've got the minimum down payment saved up, you're golden, right? Ready to go? Not so fast. It turns out having the minimum down payment is just the price of admission. It gets you in the door, but there's one last really important hurdle you still need to clear. And that final hurdle, it's called your debt servicing ratios. This is probably one of the most important things to understand. Even if the rulebook says you only need 5% down, you still have to prove you can actually afford the mortgage on top of all your other debts. Let me give you an example. Let's say you have a big car loan. The lender might look at your finances and say, hey, with that car payment, you can't afford this mortgage with just 5% down. So to get that approval, you might have to come up with 10 or even 15% down, just to shrink the size of your mortgage and get your debt ratios into a place where the lender is comfortable. And that pretty much wraps up our deep dive on down payments. Now, to help you actually put all of this into practice, I've dropped a link to a down payment cheat sheet and a net worth calculator right in the description below. They're awesome tools, seriously. They'll help you get that crystal clear picture of where you are right now in your investment journey. Hey, if you found this explainer useful, do me a favor and subscribe for more content just like this, all focused on investor education for mortgages and real estate. And look, these explainers are a fantastic starting point. But if you're ready to go even deeper, I also host live training sessions. We cover the whole shebang: credit, income, down payments, the entire buying process. You can check out the website for the next available dates. Thanks so much for tuning in.